Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Phil McInnes, Chief Investment Strategist at Avantis Investors. Avantis offers 28 actively managed ETFs, some of them very interesting strategies, and they have over 50 billion in assets under management. Phil, welcome. Great to have you on the show.
Yes, thank you, Nina. It's great to be here.
So you are joining us for the first time on this show. So please tell us a little bit about yourself and Avantis.
Absolutely. So my role as Chief Investment Strategist at Avantis, I've been here really since day one, since we started Avantis, and I'll tell you a little bit about that. My background, I started my career in the institutional side, working as an institutional investment consultant. So that was with Watson Wyatt at the time. That company is known as WTW today, but that was working with corporate and public pension plans, 401k plans, helping them with asset allocation, risk budgeting, manager selection, those things. So that was sort of my proper introduction to buy-side capital markets. I also spent a fair number of years at Dimensional Fund Advisors in Austin, Texas, which is where I live today. And in 2019, we started Avantis Investors inside of American Century Investments, which many people may know. So the idea was really, if you look at American Century, their history is a little bit more on the kind of conventional, more concentrated type of active management strategies. But they had noticed that there was a gap in types of solutions that they were hoping to offer clients. So they were looking for something more where our experience lies, which are strategies that are very broadly based, so a lot of diversification. We also tend to set management fees pretty low, kind of in the range of where you see a lot of index-based ETFs, and we'll talk a little bit more about that. But the idea was that the offering that we have could be something that was quite complementary as far as what they had for their clients already. And so a gentleman by the name of Eduardo Repetto, who's our Chief Investment Officer, another gentleman, Patrick Keating, who's our Chief Operating Officer, worked together with folks at American Century and several more of us to actually get Avantis started. So we launched the brand in June 2019, and then we put the first active ETFs into the marketplace in September of 2019. So we're just coming up. We're about a month and a half away from our 5th birthday here. But the goal for us is just to try to offer very kind of broadly diversified, low-cost strategies. There's a balance that I think we're always trying to strike of being able to do a good job of delivering the asset class that people are hiring us to manage, but try to do better than just having market cap weights inside of that asset class. And I'm sure we'll get into that in a little bit more detail here.
Very interesting. So we'll focus a little bit more on your small cap and value strategies, which have done very well, significantly outperformed their respective benchmarks. So let's start with the market. And we know that the first half of 2024 was terrific for stocks. That was mainly due to AI enthusiasm, a resilient US economy, and improving corporate earnings, and also signs of cooling inflation. But the rally was very, very narrow. It was driven mainly by mega cap technology stocks. And then a lower than expected CPI report that drove a significant shift in July because it raised the odds for the Fed to start cutting rates in September. So when we saw investors piled into small caps and value stocks and many other attractively valued areas of the market, the Russell 2000 index was July's star performer. And it was actually a violent rotation. At least initially, investors were selling the Magnificent Seven stocks and buying these cheaper areas of the market. I read that the rally was also accelerated by some short covering by hedge funds. And now, over the past couple of days, we have seen that the market dynamics have changed again, particularly today after the weak jobs report. Small cap stocks are plunging. And for reference, we are recording this on Friday, August 2nd. So in general, lower rates would benefit smaller companies, but not if the economy slows down significantly. So let's start with your thoughts on the market action so far this year and also outlook for the rest of the year.
Yes, absolutely. And I think you hit on a few important points there, Nina. And if you think back to the first half of the year, it did feel like quite a concentrated market. Stocks like NVIDIA really leading the way, contributing a large percentage of at least large cap index returns, but total market index returns as well. We did see a bit of a broadening of that market in July. And as you said, some of that rotation that was taking place. I think as we look forward, there's plenty of more news that is going to come out over the next weeks and months. And markets are always going to be reacting to that, kind of taking that new information and incorporating that in to their expectations. A big piece of our philosophy at Avantis is seeing how we might be able to use that information that's being contained in prices along with the other fundamental data we have across companies to be able to decide which companies are actually trading at more attractive discount rates, or as we say, have higher expected returns in the marketplace. So that's information that we're using to manage our portfolios. But kind of more broadly, if we think about the market, we're coming into an election. As of right now, it seems like it's going to be a pretty close election. We have looked at this in the past. If you're coming into these presidential cycles, you do see a little bit more volatility in the months leading up to. I think especially if the elections are forecasted to be close. And so I know there's a lot more. There's a lot of other things that are coming into the market today. You mentioned the jobs report a little bit weaker. I know there was some projections about the impact of the hurricane in Texas here last month having on that jobs report. So we obviously also have the Fed action or lack of action, at least thus far this year, and what people are thinking of what's going to come next. So I think we're looking at where markets were placing the odds of cuts in September. I think now there's at least they're pricing in 100% chance that there's at least a 25 basis point cut, but now there's some projections of there being a 50 basis point cut at the September meeting. So we'll obviously see what happens there. For me personally, I'm always bullish. I'm always saying that, look, prices are resetting with stocks to reflect a positive expected return. And so in my own portfolio, always going to be bullish and long stocks. But if we think about kind of the marketplace overall, and if we think about small caps relative to large caps or non-US relative to US, value stocks relative to traditional growth stocks, there's two things I would say. One, I think with some of these, and particularly if we think about small caps relative to large caps or outside the US relative to the US, in both cases, you do see some pretty significant dispersion in valuations. And that's been there for a little while now. So that's not necessarily new, but I am a big believer in valuations driving things long term. And so from that standpoint, these areas of the market I do see as being attractive. I think they're always attractive, but maybe they're a little bit more attractive than normal. The second thing I would say is that some of these traditional labels that we see, something as simple as growth relative to value, different indexes that are used to measure some of these spreads and to give indications of where different parts of the market are going. You can have very different definitions and very different underlying indexes as you go across index providers. So the idea of this is a growth stock or this is a value stock, and that being sufficient information to decide whether or not it's something that should be in your portfolio, I'm a little bit less of a believer in that. We think we got to kind of dig in a little bit more into the fundamentals and think about kind of that whole set of financials as we're deciding, is this an attractive company to have in the portfolio, or is this a stock that we expect to do well over the next 6, 12, 18, 24, however many months?
So it seems that you expect small caps and value areas to continue to outperform the recent rally that we have seen in this area. And apart from valuations, which you mentioned They are quite attractive, but they have been attractive for many, many years because these areas, small caps, have been underperforming large caps for over a decade. Value stocks have been underperforming growth areas. So apart from valuation, what other factors would drive the rally in these areas?
Yeah, no. So if we look at our small cap value strategy, so it incepted back in September of 2019. If we look at its performance, so it's done quite well relative to if you look at a small cap neutral index, if you look at a small cap value index, but actually even if you look at relative to a large cap index like the S&P 500 index, the strategy has been able to deliver excess returns above that. So we do think it kind of gets into this discussion around, well, what's your definition of value? What's if you're allocating to small, what are you considering as you're looking at those companies? Because for me, the drivers that we're always going to be thinking about, there will be shorter term influences of, again, whether that's economic reports, whether that's an election cycle, what have you. These things can have an impact on prices. They can have an impact on volatility. But going back to thinking about, as we're looking at companies, what are we getting as equity holders? What if I'm thinking about how to deploy capital and I'm considering the whole set of financials, what is the financial health of that company? What's the cash profits that it's generating? For us, when we are looking at a universe of companies, there's really two things that we're going to be focusing on broadly. And there's a lot of other components that go into this, but I'm going to start at a really high level. If we were going to go buy a company together, Nina, and we decided how much are we willing to pay for this company, right? Imagine your favorite restaurant down the street or the place where you like to go shopping for clothes. If you're thinking about buying that business, you at least have to pay for the equity in that business, right? If the restaurant happens to own the land that it's on, then you're at least going to have to pay for that. But you're not going to be investing in that business, and you're not going to be willing to pay something above and beyond that value. You're thinking about the ongoing cash flows and the ongoing expected profits that business is going to have, right? So when we think about evaluating companies, that's really the lens that we want to take, and that we think most market participants are taking as they're deciding how much to pay for these companies. So we think there's a lot of information in those stock prices and in that financial data that we can take to create a portfolio that, number one, is going to have a higher level of quality than you'll see in specifically in small caps, than you'll see in a lot of the small cap indexes, and we can speak about that. But the second piece, we can do it in a way that is really, really broadly diversified. So we're not placing all of our bets in a single company and its specific outcome, right? We're basically betting on a lot of companies overall being able to do reasonably well over the long haul.
Very interesting. And since you mentioned the indexes, let's talk a little bit about the issues with small cap indexes. And the most popular one is the Russell 2000 index. And I saw an article in the Wall Street Journal recently, which basically said that this index has a lot of low quality companies. And again, there are other issues too, because it rebalances only once in a year. And in fact, I looked at the performance of the Russell 2000 ETF, the most popular one, IWM, and compared that with the performance of the iShares S&P Small Cap 600 ETF, the most popular one, IJR. And I noticed that IJR has significantly outperformed IWM. And according to a study performed by S&P Dow Jones Indexes, the return differences are mainly due to inclusion of a profitability factor in the S&P Small Cap 600 index. And you mentioned about the importance of earnings, importance of profitability of the companies that you select for your ETF. So we'll talk a little bit about your ETF in a bit. But before that, I was interested in your thoughts on the issues with these popular small cap indexes?
Yeah, it's a great question, Nina, and I'm glad you raised it. So this is something that you can see in the data going back quite a ways, and the study that you cite from S&P showing the S&P 600 relative to the Russell 2000, and kind of doing an attribution on that and what's led to that outperformance of that index. So for those who may not be aware, for a name to be eligible for the S&P indexes, in order to basically get into the index, they have a rule that says you have to have positive net income over the last 4 quarters and the most recent quarter. And so that's that profitability screen that you're mentioning. So that is different and distinct from Russell, which has no such screen. And when you look at the small cap universe, you do see that there's plenty of them that actually have negative earnings, right? That and so from our standpoint, it's one of those where I'm actually kind of baffled at how many people just allocate to that ETF, that Russell 2000 ETF. You probably saw it even over the last couple of weeks of the assets that it brought in, with people thinking about moving to a small cap allocation. So from our standpoint, we think that S&P role it's a step in the right direction. We think that you can do a little bit more in terms of, as you're sifting through these companies and deciding where do you want to deploy capital. So the other thing that I think is really interesting among these small cap indexes is that the label small cap, kind of similar to my comments around the label value relative to the growth, it doesn't tell you enough about what's going on in the portfolio, which, if I had a bone to pick really anywhere, it's that these index-based ETFs have kind of gotten grandfathered in because they track an index. So if you track an index, then it has to be an okay investment strategy. And I don't necessarily think that that's the best line of thinking, because if you look at, let's just say, the Russell 2000 relative to the S&P 600 or relative to the CRSP US small cap index, if I look at those 3 indexes and I actually look at the companies and then the characteristics, right? So whether that's the weighted average market capitalization that tells me something about the size of that index, or the ETF that's tracking it, the size of the companies. If I look at price to earnings ratios, price to book ratios, return on equity, return on assets, if I look at all these characteristics, you see some pretty big differences for things that are kind of thought of or used interchangeably in a lot of portfolios. And so I think it's one of those where the adoption of ETFs, if we kind of take a step back, there's been a ton of adoption of ETFs because they're an extremely powerful vehicle for an investor. And a big piece of that gets into some of the structure of the vehicle and the tax efficiency that it can provide for an investor, right? Because in a mutual fund, where you have a lot more cash in, cash out kind of transactions, there's a lot of realized gains that have to get passed on to an investor. In the ETF structure, you don't necessarily have that because a lot of the activity can be done in kind. And so this feature is one that I think is responsible for a large portion of the adoption of index-based ETF strategies in the marketplace. Well, now we can have portfolios that can offer that same tax efficiency, potential, but we don't need to explicitly track an index. We don't have to follow the rules of an index methodology that's published online. And that's something where we feel like it's really a really great time to be having this conversation with allocators, with investors, because this wasn't necessarily always the case. If you go way back in time to when ETFs first kind of were made available, but it is the case now. And so we're really excited about having that conversation.
Excellent. Yeah, Russell 2000 index has certain issues for sure. And in fact, this year, this index and ETFs, the popular ETFs that track this index, they outperformed the S&P Small Cap 600 Index because it had two companies which were neither small nor value. These were Super Micro and MicroStrategy. And because of the annual reconstitution, those two companies remained in the Russell 2000 Index for a long time. They left the index only in June, at the end of June. So that was a quirk with this index. So we always recommend to our listeners, investors, that they should always look at the strategy, always look at the holdings before deciding to invest. So you talked about your ETF, your small cap value ETF. The symbol is AVUV. And as you mentioned, this has significantly outperformed its benchmark, and investors have noticed the outperformance. This has close to 13 billion in assets, I notice. So please tell us a little bit more about this ETF and another small cap ETF that you offer, AVSC. Please tell us about both these ETFs and also some of the top holdings in these ETFs that you like.
Sure, absolutely. So there's a couple things I would say. So if people are comparing and contrasting between the two, between AVUV and AVSC, one thing that's important to note is that from a philosophical perspective, they have the same underlying foundation. And so the philosophy for us, kind of going back to what I was saying earlier with, if you're thinking about buying a company, what are you going to be looking at? What do you need to consider? So that's the foundation of how we think about building really any portfolio. And then the application is going to be a little bit different based on the goal or the objective of the portfolio. We think it's always really important with any portfolio, any ETF or fund or anything that's being offered, that we start with a very clear goal and objective, and that we're very transparent about that, because I think transparency and setting and managing expectations are just really, really critical for the partnership between an investment provider and then whoever that ultimate investor or allocator is who's using it. Because if you have a misalignment in expectations, then there's a good chance it's going to lead to a less than optimal outcome. And we're after better long-term outcomes here. So if we think about that philosophy and the foundation as we're building out these strategies, and I'll start with AVUV first. So the idea is we want to make sure it's small cap. So we define a size range of eligible companies. And then within that universe, and that universe it's similar to, say, the Russell 2000 universe from a size range perspective. I think that's fair to say. Within that universe of companies, what we're doing is we're taking every single company in that range, and we're looking at, well, how cheap or expensive is it relative to its adjusted book equity? And the adjustment we're making in the book value equity is we take out goodwill. We take that out because it really isn't equity, and we're looking for the true picture of the equity of the company. So we're looking at that, and then simultaneously we're looking at, well, what's the profitability of this company? How's it doing in generating profits? And there we use a measure that we refer to as cash-based operating profitability, but you can really think about it as what's that recurring cash from operations that this business is generating. So we're taking that adjusted book to market, right? So the price relative to the equity, and then that recurring cash from operations, we're combining those together to decide, okay, how on a relative basis, how attractive do these stocks look versus one another? And in AVUV, we start buying with that most attractive company, and we go until we reach a point of about a quarter of the universe. So a quarter of that small cap universe we've been referencing. So that is a reasonably focused application of this philosophy of, over time, what we expect is companies that are trading at lower price multiples, but still with good profits, are going to outperform, right? That's really the idea. And that's what we see in the data over the long term. That's what we expect kind of from financial theory. And that's been the case in the portfolio so far. We've observed this. When you sort of contrast that, and I'll say one more thing about AVUV before we maybe transition to AVSC, we want to make sure that as we're building this out, as I was kind of alluding to earlier, we don't just want to take the 5 stocks or the 10 stocks or the 20 stocks that have these attractive characteristics, because we think that that's kind of an unnecessary level of concentration risk. What we're after are these sets of characteristics, because they're what predict that good long-term performance. So if we can spread that investment across a lot of different names, what can we do? Well, number one, that can reduce the idiosyncratic risks of a single company, right, having an adverse impact on the portfolio. But number two, it also gives us a little bit of flexibility as we think about implementation, which we think can be valuable as well. So with AVUV, you've got a portfolio that has between today around 765 stocks in the portfolio. So very broadly diversified at the company level. It's going to be really diversified across sectors. There are two sectors that we exclude in the value portfolio. One of those being highly regulated utilities. And then REITs. REITs are actually excluded from all of our equity strategies because of the tax treatment. So that's something to look out for, because it will cause differences, sort of tracking differences relative to the index. But there's good reason to leave those out. So, but you have a portfolio that's very broadly diversified at the company level, very broadly diversified at the industry and sector level, but it's giving you a focus on those ones that have much more, in our opinion, much more attractive combined fundamental characteristics and prices that hopefully produce a good long-term outcome. In contrast, and I would kind of describe that as a deep value strategy, because even though it has a lot of names, it's quite focused within that small cap space. In contrast, if we think about AVSC, so that is something that is going to be a little bit more blend-like. And so a little bit more blend-like in the sense that we aren't going to push as hard on these relationships, that idea of an adjusted book to market and cash-based profitability. So what we're doing there is we're kind of saying, let's invest across an even broader set of small cap companies. And for people who maybe just want to have a single allocation to small caps, and don't want to have it be as focused on the value side, AVSC can be a really good solution. So in that portfolio, we're looking at the same information, but we're not going to exclude as many companies out of the small cap universe as we do in the case of AVUV. So you get a bit broader coverage of the small cap universe, but something that we still think has significantly higher quality than just the Russell 2000, and is considering companies' relative prices as it's making decisions as well. It also has a fair bit of micro cap exposure in it. So in both cases, we have very, very broadly diversified portfolios, and that's something that's really important for us. But we expect to be able to do better than just kind of a market cap weighted index. With respect to names, I'll call out one name in each of them, but I'll sort of reiterate that while there's individual stocks, obviously, that whose characteristics that we like, that's how we build the portfolio. It's a bottom up way of doing it. We do make sure we have a lot of diversification in the portfolio. So in each of these portfolios, it's very unlikely you're going to see more than 1% in an individual name. So even if we like a stock, it doesn't mean it's going to have a very, very high weight in these small cap portfolios. On the small value side, I'd call out Select Water Solutions. So that's a water management services company that does water management for the oil and gas industry. That has both of those characteristics that we really like. It's got a really attractive adjusted book to market and really good cash profitability. For AVSC, the one I'll call out is NMI Holdings. So they're a private mortgage insurer. It's done very well. It's very attractive still from that that adjusted book to market and profitability standpoint. It has a very, very high ranking. So those are two companies I would call out that today in the portfolio, they've done well over the recent past, but still look quite attractive to us and will likely be in the portfolio for a good period going forward.
Great. I also wanted to talk about your large cap value ETF. The ticker symbol there is AVLV. And I was interested in this strategy. And in fact, I looked at the top holdings and I found that some of the technology giants are among the top holdings: Apple, Meta Platforms, and Amazon. 3 of the so-called Magnificent 7 stocks are among the top 10 holdings. And you mentioned that you do not believe in the traditional definitions of value versus growth. So please talk about this ETF, its strategy, and how do you find these stocks in particular attractively valued?
Yes, thank you, Nina. And great question. So And I think those are actually a couple of good names that maybe can shed some light on this idea of, again, sort of growth versus value, and maybe it not being sufficient enough. Because let's take the Russell indexes as an example in the value relative to growth definition. I know we've been talking about kind of the small cap definition already, but if you think about how Russell delineates between a value and a growth stock, and again, they do that once a year, as you said. When they're assigning a value score to a stock, there's only one variable that's considered in that value score, and it's a company's price to book ratio. So that's and price to book is just the inverse of this book to market that I've been talking about, right? And I mentioned the adjustment we make to it, but if we say so, a low price to book is attractive, sort of all else equal. It means the company's got trading at a low price relative to the book value. So all else equal, it should have a higher expected return. But in isolation, that really doesn't tell us too much about the prospects for that business. It doesn't have enough information of, is it a good buy, an attractive buy, or is it maybe something that's too expensive? That's what we would argue. That's not giving you sufficient information. So Russell, as they kind of split up the universe, they assign a value score to every company. They also assign a growth score. Now that growth score is based on past earnings growth and then future estimated earnings growth. So companies get a growth score and a value score. Some companies only end up in the value index or only in the growth index, and some end up in both, but at different weights. So that, for me, again, sort of earnings growth. Okay, you might be able to say there's some correlation with the level of earnings or profits, but again, it's really not going to the actual point. The actual point, in our opinion, is what's the profitability of the company, right? What are the profits it's being able to generate? Because current profitability is a very good indicator of future profitability on a relative basis. So when we look at companies, if you take those companies you were just mentioning, an Apple or a Meta, and you look at just the book to market of the company, the adjusted book to market, they probably don't look so attractive, and that's why they typically aren't in the Russell 1000 value index. That said, when you consider the relative attractiveness of the company after looking at its profitability alongside that adjusted book to market, it starts to look a lot more attractive. And that's our definition of value, is thinking about both those things together. So that's why those companies show up in there. And that's why I think that, value relative to growth, again, that label, probably not enough to tell us is this an attractive company or not, right? I think somewhere along the line, value investing just, it ended up being just buy cheap stuff and it'll go up. Well, there's not really so much value in everything that's cheap, right? We want good deals. We think about it when you go out for dinner, when you tell somebody about that experience after the fact, you don't say, well, the bill was really small, so we had a great time, right? The price is a component. If you felt like you got a really good deal, that's great, but you also care about the quality of the experience, the quality of the ingredients, the way that the food was prepared. It's everything together, and we think sort of similarly about identifying value in stocks. It has to be about more than just price. Price is an absolutely vital component, but it has to be about more than that if we're thinking about the long-term prospects.
Excellent stuff. Well, yes, I agree with you. All these companies, these are profit machines. So if you consider that, they do look attractively valued. We'll have to leave it there. Thank you so much for joining us today, for sharing your insights, and also congratulations on excellent performance of your strategies.
Thank you so much, Nina. I appreciate it.
That was Phil McInnes, Chief Investment Strategist at Avantis. Let's quickly recap the ETF tickers that we talked about. So the most popular small cap ETF is the iShares S&P Small Cap 600 ETF. The ticker symbol is IJR. And the most popular Russell 2000 ETF is also by iShares. It is IRR. IWM. But as we mentioned, IJR has significantly outperformed IWM since its inception, though IWM has done better this year in particular mainly because of those two stocks that we talked about. Now let's talk about Avantis ETFs that we discussed. The small cap value ETF is AVUV, and the broader small cap ETF is AVSC. And we also talked about large cap value ETF. The ticker symbol there is AVLV. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.